Every second, millions of payments move through the global economy. People buy coffee, shop online, book hotels, and pay subscriptions without even thinking about what happens behind the scenes. But hidden behind many of those transactions is one company quietly taking a small piece of the flow. Visa. A company that became one of the most powerful financial businesses in the world. Not by lending money. Not by taking huge credit risk. But by building a network so deeply embedded into the global economy that billions of transactions depend on it every single day. Yet the payment industry is beginning to change. Fintech companies are expanding rapidly. Digital wallets are becoming more dominant. And new technologies could reshape how money moves in the future. So the big question is this. Can Visa continue dominating global payments for the next decade? Or is the company approaching a slower phase of growth as competition intensifies? In this video, we will break down the business, the moat, the risks, and the valuation behind Visa stock. Even great businesses can become bad investments if investors pay too much for the stock. And that is why valuation matters. Because no matter how strong a company may be, future returns still depend heavily on the price investors are willing to pay today. In the case of Visa, the market has consistently assigned the company a premium valuation. Why? Because Visa combines several characteristics investors rarely find in a single business. High margins. Strong free cash flow. Powerful network effects. Global scale. And highly predictable long-term growth. But premium businesses usually come with premium expectations. Which means investors must constantly ask an important question. Does Visa still have enough future growth potential to justify its current valuation? Or has the market already priced in most of the company's long-term strengths? That is exactly what we are going to explore in this analysis. Before discussing Visa's valuation, we first need to understand one important concept. Fair value. Fair value is essentially an estimate of what a company is truly worth based on its business fundamentals, future growth potential, profitability, cash flow generation, and long-term risks. In simple terms, fair value represents the price investors believe a stock should trade at under normal market conditions. If the stock trades below fair value, investors may consider it undervalued. If the stock trades far above fair value, the market may already be pricing in very optimistic expectations. But it is important to understand that fair value is never an exact number. It is an estimate. Different analysts can arrive at different fair value calculations depending on their assumptions about future growth, margins, interest rates, competition, and economic conditions. That is why valuation is both a financial exercise and a judgment about the future of the business itself. Now let's look at Visa's valuation scenarios. In this analysis, I use multiple valuation assumptions ranging from conservative estimates to more optimistic market expectations. The conservative scenario applies a lower PE multiple, which reflects slower consumer spending growth, weaker transaction volumes, or possible market multiple compression. In this case, Visa's estimated valuation would be around $259 per share. The historical scenario reflects valuation levels that are closer to Visa's long-term average market multiple. This produces an estimated fair value of approximately $315 per share. And finally, the optimistic scenario assumes Visa continues benefiting from strong global digital payment growth, high profitability, and durable competitive advantages. In this scenario, the valuation could potentially reach around $404 per share. By comparing these valuation ranges, investors can better understand potential upside, downside risk, and how much future growth expectations are already reflected in the stock price. Because for premium quality businesses like Visa, valuation often matters just as much as business quality itself. Visa is one of the largest payment networks in the world. The company operates a global financial infrastructure that connects consumers, merchants, banks, businesses, and payment platforms across more than 200 countries. But one of the most important things investors need to understand is this. Visa is not a traditional bank. The company does not lend money directly to consumers. It does not hold customer deposits. And it does not carry the same level of credit risk as banks. Instead, Visa acts as the network that allows digital transactions to move quickly and securely between different financial institutions. Every time a customer taps a card, shops online, or makes an international payment, Visa's network helps process the transaction. And in return, the company earns fees from the enormous volume of payments flowing through its system. Visa generates revenue from several major areas. The first is payment volume. As more money moves across the network, Visa benefits from transaction-related fees. The second is data processing. Visa earns fees every time transactions are authorized, cleared, and settled through its infrastructure. Another highly profitable segment is cross-border transactions. When consumers make purchases internationally, Visa typically earns higher fees because of currency conversion and international processing. And beyond payments, Visa has also expanded into value-added services. This includes fraud detection, cybersecurity solutions, data analytics, consulting services, and payment technology for businesses and financial institutions. Over time, this transformed Visa from a simple card network into a massive global payments ecosystem. And because digital payments continue replacing cash transactions around the world, Visa remains positioned at the center of one of the largest long-term financial trends globally. Visa operates one of the strongest payment networks in the global financial system. The company's biggest advantage is scale. Visa has built an enormous acceptance network across merchants, banks, online platforms, and financial institutions around the world. That scale creates a powerful network effect. The more merchants accept Visa, the more consumers use it. And the more consumers use Visa, the more valuable the network becomes for merchants and banks. This makes Visa extremely difficult to replace. Its closest traditional competitor is MasterCard. In many ways, MasterCard operates a very similar business model. Both companies dominate the global card payment industry. Both generate extremely high margins. And both benefit from the long-term growth of digital payments worldwide. However, Visa still maintains the larger global payment network and processes higher payment volume overall. That scale advantage gives Visa stronger global acceptance and deeper integration across financial systems. Another competitor is American Express. But American Express operates differently. Unlike Visa, American Express acts both as a payment network and a card issuer. That means the company takes more direct credit risk. American Express is also more focused on premium consumers and business spending, while Visa operates a much broader global payment ecosystem. The competitive landscape becomes more interesting when looking at fintech companies. Platforms like PayPal, Block, and digital wallets such as Apple Pay are changing how consumers interact with payments. But in many cases, these platforms still rely on Visa's underlying payment rails. For example, when consumers use a digital wallet, the transaction is often still processed through Visa's network in the background. This means many fintech companies are not fully replacing Visa. Instead, they are building additional layers on top of existing payment infrastructure. However, the long-term threat comes from real-time payment systems and account-to-account transfers. Some governments and financial systems are developing payment networks that bypass traditional card rails entirely. At the same time, blockchain technology and stablecoins could eventually create alternative ways for money to move globally without relying on traditional payment networks. Even so, Visa still maintains several major advantages. Its brand is trusted globally. Its infrastructure is deeply embedded into the financial system. Its fraud detection capabilities are extremely advanced. And replicating Visa's global merchant acceptance network would require enormous time, capital, and regulatory integration. That is why, despite increasing competition from fintech companies and emerging payment technologies, Visa continues to remain one of the most dominant players in the global payments industry. Visa delivered another strong quarter in Q2 fiscal year 2026, continuing to demonstrate the resilience and scalability of its global payment network business. Revenue reached approximately $11.2 billion during the quarter, supported by healthy consumer spending, solid transaction growth, and continued strength in cross-border payments. Meanwhile, adjusted earnings per share increased to around $3.31, coming in above Wall Street expectations. One of the biggest highlights this quarter was the strength of cross-border transaction growth. Cross-border volume increased approximately 12% year-over-year, showing that international travel and global commerce remain important growth drivers for Visa. This segment is especially important because cross-border transactions typically generate higher margins compared with domestic payments. Processed transactions also continued growing at a healthy pace, increasing roughly 9% year-over-year as digital payment activity remained strong globally. Another major contributor came from Visa's value-added services business. Segments such as fraud prevention, cybersecurity, data analytics, and commercial payment solutions continued growing significantly faster than the company's core payment network business. This highlights Visa's strategy of expanding beyond traditional card payments into broader financial infrastructure and payment technology services. Despite continued investments in technology and innovation, Visa maintained exceptionally strong profitability during the quarter. The company's business model remains highly efficient, allowing a large portion of revenue to flow directly into operating profit and free cash flow. Visa also continued aggressively returning capital to shareholders through share repurchases and dividends, supported by the company's enormous cash generation capabilities. Overall, Q2 fiscal year 2026 reinforced the idea that Visa remains one of the strongest and most durable businesses in the global financial industry. Even as competition in digital payments continues increasing, Visa's scale, network effect, and profitability remain extremely difficult to replicate. Following the Q2 fiscal year 2026 earnings release, investor sentiment toward Visa remained very constructive. The market reaction was driven not only by strong financial results, but also by growing confidence that Visa continues benefiting from long-term structural trends in global digital payments. Investors were especially encouraged by the continued strength in consumer spending, resilient transaction growth, and strong momentum in higher-margin cross-border payments. At the same time, the quarter reinforced the perception that Visa's business model remains highly durable even in a rapidly evolving payment landscape. Another important factor behind the positive reaction was Visa's ability to maintain strong profitability while continuing to invest in technology, AI capabilities, and new payment infrastructure. For many institutional investors, this reinforced the idea that Visa is not simply a traditional payment company, but a global financial infrastructure platform with significant long-term scalability. The market also responded positively to the company's expanding value-added services business. Areas such as fraud prevention, data analytics, commercial payments, and Visa Direct continue growing faster than the core network business, giving investors more confidence in Visa's ability to diversify future revenue streams. At the same time, management commentary around AI-driven commerce, real-time payments, and stablecoin initiatives attracted growing investor attention. Many investors increasingly view Visa as one of the few companies capable of adapting successfully regardless of how the payment ecosystem evolves in the future. However, despite the strong reaction, some investors remain cautious about valuation. Because Visa is widely considered one of the highest quality businesses in the market, expectations remain extremely high. As a result, the market continues watching closely for any signs of slowing consumer spending, weaker payment volume growth, or rising competitive pressure from fintech platforms and alternative payment systems. Overall, the Q2 fiscal year 2026 earnings reaction reflected a combination of confidence and elevated expectations. Confidence in Visa's long-term business quality, profitability, and global network dominance. But also recognition that the stock's premium valuation requires the company to continue executing at a very high level. Now we are looking at a small portion of Visa's financial ratios for fiscal years 2025 and 2024. Starting with gross margin, Visa reported a gross margin of 80.36% in fiscal year 2025, relatively stable compared with 80.4% in fiscal year 2024. This level of profitability is extremely high and highlights the extraordinary efficiency of Visa's payment network business. Even after processing billions of transactions globally, the company still retains the vast majority of its revenue after direct operating costs. Next, return on invested capital, or ROIC, came in at 32.07% in fiscal year 2025, slightly lower than 34.33% in fiscal year 2024. Despite the small decline, this remains an exceptionally strong level of capital efficiency. It shows that Visa continues generating enormous profits relative to the capital required to operate the business, which is one of the defining characteristics of a high-quality compounder. Meanwhile, free cash flow margin improved to 53.94% in fiscal year 2025, compared with 52.03% in fiscal year 2024. In other words, more than half of Visa's revenue ultimately turned into free cash flow. That is a remarkable level of cash generation for a company operating at Visa's scale. Finally, interest coverage increased to 40 times in fiscal year 2025, up from 36 times in fiscal year 2024. This indicates that Visa's operating income remains far more than sufficient to cover its interest expenses, reflecting the company's strong balance sheet and low financial risk. Overall, these financial ratios continue highlighting the strength of Visa's business model. High margins, strong capital efficiency, massive cash generation, and solid financial stability remain key reasons why Visa is widely viewed as one of the highest quality businesses in the global market. Looking ahead, several positive catalysts could continue supporting Visa's long-term growth story. The first major catalyst remains the global transition from cash to digital payments. Even today, a significant portion of transactions worldwide still relies on cash, particularly in emerging markets. As digital payment adoption continues expanding globally, Visa remains positioned at the center of that transformation. Another important catalyst is the continued growth of cross-border payments. International travel, global commerce, and online spending continue recovering and expanding over time. Because cross-border transactions typically generate higher margins, sustained growth in this segment could remain a powerful earnings driver for Visa. E-commerce growth also continues benefiting the company. As consumers increasingly shift toward online transactions, digital payment volume keeps rising across global markets. And in many cases, Visa's infrastructure remains deeply integrated into the payment flow behind those transactions. Another major growth opportunity comes from Visa's expansion beyond traditional card payments. The company continues investing aggressively in value-added services such as fraud prevention, cybersecurity, AI-powered analytics, commercial payments, and financial data solutions. These businesses not only diversify Visa's revenue streams, but also strengthen the company's ecosystem and deepen relationships with merchants and financial institutions. Visa Direct could also become an increasingly important long-term growth engine. The platform enables faster money movement for consumers, businesses, and financial institutions across different regions. As demand for real-time payments continues growing globally, Visa Direct may play a larger role in the future payment ecosystem. Artificial intelligence could become another meaningful catalyst. Visa is increasingly integrating AI capabilities into fraud detection, transaction security, risk management, and payment optimization. As digital commerce becomes more complex, AI-driven infrastructure could strengthen Visa's competitive advantages even further. The company is also positioning itself to participate in emerging payment technologies, including stablecoin settlement infrastructure and blockchain-enabled payment solutions. Rather than resisting industry change, Visa appears focused on integrating new technologies into its existing global network. And finally, Visa's financial strength itself remains one of its biggest advantages. The company generates enormous free cash flow, maintains very high margins, and operates a highly scalable business model. This gives Visa the flexibility to continue investing in innovation, expanding globally, repurchasing shares, and returning capital to shareholders over the long term. Despite Visa's strong business quality, investors should also pay close attention to several risks and negative catalysts that could impact the company's long-term growth. One of the biggest risks is increasing competition across the global payments industry. Fintech companies continue developing alternative payment solutions that aim to reduce reliance on traditional card networks. Digital wallets, account-to-account transfers, and real-time payment systems are becoming more common in many regions. Over time, these technologies could reduce the number of transactions flowing through traditional payment rails. Another important risk is regulatory pressure. Governments and regulators around the world continue examining transaction fees, interchange structures, and market dominance within the payment industry. If regulators push for lower fees or stricter rules, Visa's profitability could face pressure in the future. There is also growing competition from large technology companies. Platforms integrated into smartphones, ecosystems, and digital commerce are increasingly shaping how consumers make payments. Even if many of these platforms still rely on Visa's infrastructure today, the long-term competitive landscape could become more complex. Macroeconomic conditions also matter. Visa's business is closely tied to consumer spending activity. During economic slowdowns, payment volumes, discretionary spending, and international travel can weaken, especially in higher-margin cross-border transactions. Another long-term concern involves blockchain technology and stablecoins. While these technologies are still evolving, they could eventually create alternative systems for transferring money globally without relying on traditional payment networks. And finally, because Visa is already viewed as a high-quality business by the market, the stock often trades at a premium valuation. That means expectations are already high. So even if the company continues performing well operationally, slower growth or weaker guidance could still create pressure on investor sentiment and valuation multiples. Visa may not be the most exciting company in the market. It is not leading the AI revolution. It is not building electric vehicles. And it rarely becomes the center of market hype. But behind the scenes, Visa operates one of the most important financial networks in the global economy. Every day, billions of transactions move through its infrastructure across consumers, merchants, banks, and businesses worldwide. And over decades, the company has built an incredibly powerful competitive moat driven by scale, trust, and network effects. What makes Visa especially attractive to long-term investors is the quality of the business itself. High margins, strong free cash flow, excellent capital efficiency, and a highly scalable business model that continues benefiting from the long-term shift toward digital payments. At the same time, investors should also recognize that the payment industry is evolving rapidly. Fintech companies, real-time payment systems, blockchain technology, and digital wallets could reshape parts of the industry over time. But so far, Visa continues showing an ability to adapt, expand its ecosystem, and remain deeply embedded within the global financial system. Ultimately, the key question for investors is no longer whether Visa is a great business. The real question is whether the company can continue growing fast enough to justify its premium valuation over the long term. And for many investors, Visa still remains one of the highest quality compounders in the global market today. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching, and if you enjoyed this analysis, don't forget to like, subscribe, and share your thoughts in the comments below.